Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow. Unbelievable how much stuff is going on at one time. Just blows my mind. And it's been interesting to say the least. And just keep the people in Ukraine in your prayers. That has got to be an unbelievably difficult set of circumstances to be living in. So interesting. What's really interesting about it is that the stock market's not really down more than it is. I'm surprised about that. It's well, I guess actually not really. When you look at what markets do, and that's actually, that's just so that you know. The first 15 minutes we're going to talk a little bit about the stock market, the economy, that kind of thing. It's better than you think it is. But it's just hard with the backdrop of what's going on over in Europe to get too excited about much. And a lot of people are extremely fearful, and that's good reason to be. I mean, there's a lot of stuff going on, and a lot of it's not in your control, and that's one of the things that when you're investing, you have to realize that there are going to be a lot of things that you cannot control. And this isn't the first time this has happened, by the way. Actually, just before I was born, there were Russian nuclear warheads stationed in Cuba. You know how close Cuba is? People have been able to swim from Cuba to Florida. That's close. That's really close. But same sort of thing back then. We had there was a 27% drop in the, I think it was a Dow. I don't think, they didn't really refer to the S&P 500 much back in those days. So President Kennedy said, you either get him out or we're going to bomb you right now. And, the situation actually was handled. There was no bombs that went off, and market recovered fairly quickly. But, it's just nothing's really new. I mean, nothing's really new. You go back hundreds of years. Actually, if you go back into Europe, their stock markets are a lot older than ours are. And you go back to their stock markets in the 1800s and you look at where they are today, do you know they've actually outperformed our stock markets? Their markets have outperformed ours, and they had 2 world wars fought there. It's amazing. It's not fun. It's not easy, particularly if you are older. Yes, when you're older, you don't have a whole lot of time to be able to close. If you're down a lot, you don't have a whole lot of time to recover that. So you got to be really careful with that. And that's what we've always talked about. And I kind of want to review it again today. This, no matter what the economic environment is, when you're doing your risk tolerance questions or having that conversation with your financial advisor, if you have one, if you don't, when you're trying to figure out how you should be behaving yourself, the idea is, or this out, you know what, never mind. I'm just going to tell you how I do it. So I take a look at how much I'm willing to be down by. Now, I know that the stock market can drop 50% or more because I've seen it happen in my lifetime more than once. Okay. It doesn't happen often, but it happens. So if that were to happen again, and if my assets were cut in half, and in the Depression, by the way, it was more like 85%. But that's before we had an SIPC. That's before the FDIC. That's before the SEC. The financial markets were largely unregulated back in those days. And we've also learned from those experiences. So I kind of take a look at a 50% drop being a probability because it's happened several times in my lifetime. I figure if I'm going to live 20 years, which my life expectancy is actually a little longer than that right now. Thank goodness. Yeah, I think. But so if there's a pretty good chance that at some point in time, I'll be down, my stocks will be down 50%. So if I don't want to be down 50%, and because I'm afraid that, I might not recover from that, then I don't put 100% of my money in stocks, because the other thing that people are trying to do, everybody, by the way, is looking for the reasons that the stock market's going to go back up. And that's what they always do. The average investor is always trying to predict what's going to happen. Not only is that impossible, but it's not necessary. You do not have to know what's going to happen to be able to to be able to get great long-term returns. You just don't. In fact, if you did, that's why everybody in the industry talks about rebalancing, but nobody goes along to explain why are you going to rebalance your portfolio? Because let's say you had 50% of your money in stocks, 50% of your money in short-term bonds, and the market dropped 50%. Okay, so you're only down 25. You're only down 25%. And guess what? You got 50% of what you used to have is still sitting in short-term bonds, which probably haven't dropped much, if any at all, depending on what bond funds you purchased. Okay. And then you can take some of that safer money, you can add it to your stocks. That's called rebalancing. Bring it back to 50-50. Because when you're down 50% and you had 50% of your money in stocks, your portfolio is worth 75% of what it was worth before. Think about that for a second. Everybody that was 100% stocks and thought they were going to jump in and jump out at the right times. And by the way, that happens so rarely. And I'm going to say it never happens. I've never seen anybody willing to show me their statements, to show me when they got in, when they got it, and nailed it. And I don't want to see your paper statements, by the way, because you can manipulate those on you got a laser printer. You can make your own statements up. We'll go log on to your accounts through the custodian. But, that's neither here nor there. The bottom line is that's really hard to do, and it's not necessary. Like the example I was giving, if you're going to be down, you can't stand to be down 50%, but you think, well, I think I could live through 25% of a decline in my portfolio value. Great. So you only put 50% of your money in stocks. The other 50% is going to have to stay in something safe. Okay. And there are two reasons for that. First of all, you can't, you have set your own limit as to your pain tolerance. I think I'd be down 25%. Secondly, if you do anything else with that money that's not safer, and it's not going to be there when you need to access it so that you can add to your stocks. Because one thing I can tell you, one of the reasons that stocks have a tendency to do better than the other asset class as investments is they'll raise prices to cover their costs when their costs are going up. You think Procter & Gamble is going to take all this inflation on the chin? They're just going to volunteer to pay those the extra monies that they're paying to produce their products, to get their products shipped and put on grocery store shelves. You really think they're going to do that out of the kindness of their hearts? That's not what they're there for. They're there to earn profits for their investors. And by the way, anybody that's got a fund in a 401k probably has some shares of Procter & Gamble. You may not know it, but you probably have it. And so by the way, that's the right thing to do. And that's why stocks have a tendency to do better. See, bonds are fixed. They have a fixed rate of interest. That interest rate's not going to change depending on what the economy does. And if the economy goes to crap, they may lower interest rates. You might be happy. If the economy starts to overheat, they may raise interest rates, which is also a good way to lose money in a bond fund. If you're in the wrong bond funds and they start raising interest rates, you're going to lose your shirt. Why? Well, let's say you've got a bond that's paying 3%, which means right now you're probably in a corporate bond because no government bond pays that, no CD pays that, no tax-free bond pays that. Okay, you are definitely taking risk to get a 3% return. Right? So you're probably holding a bond that's at least 30 years in maturity. It's going to give you $30. If they raise interest rates to 4%, the new bonds coming out are getting $40 a year, and you're only getting $30 a year. Why would anybody pay you full price to get your $30 when they can go buy a new one and get $40? The answer is they won't. You're going to have to take less money for those bonds that you held on to. So this is where we're at. We're in a place where interest rates are very low. They may start coming up despite the fact that the government has already issued all that debt. And by the way, I am altering my opinion from the past 5 or 6 years. The past 5 or 6 years, I've been saying, interest rates aren't going up. Interest rates aren't going up. They're not that dumb. The government's not going to raise interest rates when they owe all that money, because that would mean that they have to pay that extra interest on all that debt that they owe. Those bonds that they're selling them to us. Guess who pays the interest on those? They do. So, and now it looks as though they may start to raise the interest rates anyway. So I went back and I looked again, reviewed some of the material. They did the same thing after World War II. They started printing a bunch of money, paying for reparations, helping these countries get back up on their feet, and spending a lot of money, despite the fact that the debt to GDP ratio is about the same as it is right now because they had to finance World War II, and they raised them anyway. And so maybe they will, maybe they will raise rates. And if they do raise rates, that the big sucking sound you hear is the deflation of all the long-term bonds out there, or any of the bonds that have a lot of risk to them, because their prices are going to be dropping. Why would you want to take that kind of risk when you can get lower risk bonds whose interest rates may be as high or higher than yours? Okay, so that's kind of where we're at with the interest rate thing. So what does that leave? Well, it leaves stocks. And by the way, there are a lot of stocks that haven't participated that much in the past few years in the market. You're starting to see some of them starting to move. How do I know? Because I look at scans every day. I look at what's moving right now, and I do it every day. And there's a company, food distribution company. It's called Spartan. It peaked out in 2017, around $40. Goes all the way down in 2020, not sure why, to $8.93. That's a big drop. Now it's back to $34, and it's been running. Okay, that stock's been running fast over the past few months, actually the past couple of years. Here's another one, Blue Links Holdings. I'm not even sure who this company is, but on my scan it says they make building materials. Price to sales ratio 0.22. You know what the long-term average of the S&P is? It's 3. So when you normally have to pay $3 for every dollar's worth of sales, and now a company's up there selling for 22 cents, I go, well, that might be worth looking into. But the fact that it's moving now is a good thing. Office Depot, price to sales ratio 0.24. Long-term average for that industry is right around 1. Not as high because the profit margins aren't nearly as high. But this one's selling at 0.24. Okay, so, and again, you go down the list, and there are just a ton of companies. Worthington, there have been steel companies coming up. Hewlett Packard, which is really not they're a technology company, but they're so huge now and they do so many things. It's a strange situation. I'll just put it that way. Railroad company comes up. This is pretty interesting. That stock was down to $10 back in 2020 when nobody was ever going to ship anything by rail again. Down from $64 down to $10. Now it's at $51. This is my point. That's an extremely cyclical stock. Oil and gas, a lot of those companies have been coming back up. Here's another builder's resource. That's another building materials type company. Let's see. Methane, corporate, basic materials, chemicals. Yep, same type of thing. My point is that a lot of companies that are coming up, these companies have not done that well the past 2-3 years. And actually, if you go back long time periods, they were probably a lot higher 8 to 10 years ago than they are today. And now they're starting to move again. Why is that? Well, because a lot of the Googles and the Apples of the world have been flying for the past 5 to 7 years. And now their prices are reflecting most of the good growth that they may have over the next 5 years. And so you're seeing a rotation going on in the stock market. So a lot of those value-oriented funds that you probably hated over the past 5 or 6 years are starting to get some attention. They're starting to get some cash flow to them. That's a good thing. You know what I forgot? Bob Klingman is an enrolled agent, and he's going to be calling. He's going to be calling right after the commercial break. And I asked him to call in. I refer him to a lot of people. He's actually on retainer for my firm. So he answers a lot of questions, tax questions for a lot of my clients. And he also prepares taxes. So if you wanted to use him to prepare your taxes, you can contact him there. And he's going to be calling in after the radio. We're going to talk a little bit about the required minimum distributions. Because if you didn't take yours last December, you've got till April 15th of this year to get it. And he's going to explain a lot of that stuff because they've changed that again. I'm going to have to take the class on just for individuals. I'm not taking the business income tax. It has changed so much since the last time I've studied that material that this fall I'm taking the class. I'm just tired of not knowing anymore or having to look everything up every single time or getting Bob on the phone, which is typically what I do. I get Bob on the phone instead of looking it up. And he's been a very good resource. So, again, you want to hang in there because we're about to take a commercial break in a minute or two. And then Bob Klingman, enrolled agent, and you can call in and ask questions too, 216-901-0945. 216-901-0945. And he's going to be on the phone here right after we come back from these commercial messages and tell us how to handle some of those required minimum distributions. Just one of the many things he does. Hey, I can barely hear the music. That's the, guess not. Yep, there we are. Stay tuned. This is Bill Bullington right here on 1420. I'll be right back.
My best friend gave me the best advice. She said each day's a gift and not a gift, and right. Leave no.
Well, I may not be the greatest
Right.
man to walk this earth.
Welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to talk to me about your own situation, feel free to give me a call, 330-664-0700. That's my office number. Or you can go to my website, bullingtoncapital.com, and we can. I'd be glad to answer any questions that you have and help you try to figure out a plan to make your money last as long as you do. That's basically what we do at our firm. And I'm going to take a real quick phone call now, right before I go to Bob Klingman, and I got Richard's been waiting patiently. Richard, you're on the Bullington Capital Report.
Yes, I've talked with you before. I wrote a letter to Jeremy Siegel, who's a professor my age, 77, at Wharton School.
Yes.
And he had said back in 18 that it's probably better for the small investor to just buy and hold. And that's what some people have done over the years, but the problem with that is that they eventually end up with no new issues. And they also end up with only, let's say, one tech company.
Right.
And that might be IBM or something.
Right. Yeah.
And so buy and hold is okay for small investors, I think, because the market always goes up. But I sent him this letter that compares my own family accounts, and it shows that during the great bull market, you can easily be in 100% stocks. I'm in the 100% stocks all the time, but the account that I have in the market from '09 to when this bull market ends, I don't know if it's ended now, but it's certainly looking grim for it. My account is now worth millions of dollars worth more than other people in the family who are in only 60% stock.
Yep. How much do you need to take out of your account each year to live on?
I take out 3%.
Okay.
And now...
How long have you been doing that?
And my brothers who have their accounts, they take out 4%. Now, at the size of my account, I get more at 3% than they do out of 4%. But they don't like to follow the advice of their younger brother. But I told them that you need to be in 100% stocks when you have the greatest bull market. But I didn't know it was that. But I knew that when Trump's presidency came along, it made more than 200 new highs.
Yeah, that's that's interesting, and I think you've called in before. I'm pretty sure you have. And most people don't have the resources you do, and most people could not live on 3% of their assets, unfortunately. And so, to give that advice out to the average person I would be doing a big disservice, because they would go through one of those 50% declines. They're not going to make it out on the other side. Okay. You will, because you've got enough money and staying power to do that.
Well, the only problem is you can't sell at the bottom and then wait for the market to go up and buy again, because you'll miss a few days that it goes up hundreds of points.
Yep.
To recover.
Yeah, I know. That's funny when I see those reports that show, well, if you miss the 10 best days, you should, and if you miss the 10 worst days, the performance actually goes up significantly. If you miss the 10 best days, you might as well have left your money in the bank. But so what that meant to me was, just don't try to guess. Just leave that out. Just go into it with a plan, like what I was talking about earlier, and that's something that you should talk to your financial advisor about. I've got a couple of people out of my client base that could live off of 3%. Everybody else is probably going to have to take, well, I shouldn't say it's about a couple percentage points. So, of
course, when you live off higher, you impede the growth of the account.
Yes, absolutely. So anyway,
nothing can be done, but I think, buying and holding stock is okay, but if people have any assets, it isn't, because.
Well, I would buy it if I'm going to buy and hold. I'm not going to. I won't buy and hold individual stocks. I would not do that. I would do it as a group, a basket of stocks, and it's a lot easier and it's more tax efficient to do that in ETFs right now. But I've actually got to run because I got a guy on hold that I got to take. But
all right, fine. That's good. I should send you this letter I sent to Jeremy Siegel. I'll try to see if I can get it to you.
Okay, that sounds great. Thanks, Richard. Have a good weekend. Bye. And I got Bob Klingman. Hey, Bob, are you there?
Yes, I am, Bill. How are you?
Oh, pretty good. I have. I don't know if you've been listening or not, but we had a caller and he was running over. Okay, so I've already let the audience know that you'd be calling in. You're an enrolled agent, and we're going to be talking a little bit about the RMDs this year, and that's just one of the things that's changed, and it's changed a lot. And I've been fielding a ton of calls from people who are confused as to what they need to do, which is why we like to use people like you.
And that's what we're here for. That's what we do. That's part of what we do. If you do have a tax preparer, that's only one piece of their work.
Right. Small piece.
A piece of it. The other one should be planning also.
Yeah, and that's one of the things I like about what that previous caller was talking about. He was talking a little bit about buy and hold, and if you're going to do that, individual stocks are not a good thing to do that with because the risk is just too high.
Correct.
But if
and the thing that he spoke about, which is true, his 3%, I don't know his age, but I am seeing it now too with people with a lot of money in these funds, and when they do take their RMDs, they're quite a bit of money. There's quite a bit in there.
Right.
And what happens is, and it's a good thing, I mean, okay, you've got money, but there's other tentacles tied into when your income goes up, such as the IRMA, which is, for securities, the income-related monthly adjustment. If that goes up to a high point, you're going to be paying more for your Medicare than the $170-some a month now. It goes up dramatically. It can go up to $450 a month, but that's because of your required money that's in there. I mean, if you're making money, that's okay. You can pay for it.
Right.
But that's just something you need to think about.
Yeah, there was not to get too complicated, not to bring a whole bunch of unnecessary work on myself, but when people have really big taxable accounts, the ETFs, I don't know how many investors realize that Congress was lobbied by the financial services industry so that most ETFs that are holding stocks, when they're buying and selling, which they're doing all day, every day, they don't have to report that stuff. And the argument went, there was too much activity. The IRS will never be able to do anything else except for the audits on every single fund out there because of the number of transactions and the buys and sells. So why don't we just tax them on the sell of the fund itself? And if you hold on to the fund, if you've held on to it for more than a year, you qualify for long-term capital gains tax. If you hold it for less than that, you'll have to pay short-term on it. But instead of doing all the capital gains distributions that a normal mutual fund would do, they're just going to...
Yeah, you would never be able to.
Right. And so they're a lot more tax efficient. You might be able to find a fund, and this, one of the reasons that is so prominent in my own mind, in 1988, people were getting these big tax bills from these mutual funds that they had held onto, but they had never sold anything. And they were wondering, why am I getting this big tax bill? Well, because in 1987, the market dropped like a rock. A whole bunch of people pulled money out of the stock market, and they were forced to pay taxes on somebody else's gains.
and you're seeing that again this year that I am seeing, but coming from the non-qualified, which I mean non-qualified just means that they're not in an IRA, and seeing huge capital gains that people have, and people don't realize it until they go and do their taxes that you've got these huge capital gains and you've got to pay tax on it. And once again, here we go again. I mean, if you're collecting Social Security, it's going to kick more of that Social Security taxable in too.
Right. Yeah.
So it's just, you got to be careful.
Yes. And there are, by the way, today, they weren't very popular. They're still not very popular, but you have tax-deferred annuities that only invest in mutual funds, and they're investment only. They have very little insurance cost in them because they don't offer it. You can add the insurance to it if you want to, things like a death benefit and an income benefit. But as long as you're not taking the money out, it just stays in there and grows on a tax-deferred basis. So that's pretty good. The ETFs I like a lot. Those are, if you're not selling it, you rarely get a really negative surprise by a capital gain distribution. I won't say never because it has happened once or twice, but it's highly unusual.
Right. I like the ETFs a lot. I do.
Oh, man, I love them. I mean, when you go through and you really read them, and when you've been managing money as long as I have, I don't care what type of strategy you're going to use, whether it's a deep value or you're an aggressive growth. There's a fund out there that's doing it.
Oh, there is. I mean, but then once again, as you just said, I mean, the people have to be, a lot of people like, just dump money in and let somebody else do the work. Sure. You have to be diligent yourself.
Oh.
And take a look at it too.
Big time. Actually, the gentleman that just called, he watches his stuff extremely closely. So, and not everybody has that kind of time. Actually, I don't know people who have that kind of time.
No, but there goes to the point, too. I mean, you can go too far one way or the other.
Yeah.
You just can't sit there and watch it every day, and then you just can't sit and forget it either.
Right. Yep.
There's a happy medium someplace.
Yeah, that's the happy medium I call an ETF.
It's an ETF, and that's where you come in.
Yep. And, yeah, I remember there's lots and lots of circumstances, and in a way, it's a little easier. And what's really wild for me, anyway, and I'm sure it helps you out a lot. We were just kind of talking about the deferral of the capital gains until you actually sell it.
Correct.
So you can wait and sell it. There are things you can do, like maybe sell enough for 2 years so that you only have to pay the higher taxes this year. And you've got the withdrawals you were going to take for next year. You got them leaving them in a savings account or your money market account. So you've doubled up. You're going to pay the taxes on it. If you get to skip one of those years where you would have paid taxes. But
that's right. That's correct.
And I'm only saying this stuff because you're on the line, because I don't have a tax preparer's identification number.
No.
And I am not allowed to give tax advice. That's why Bob's very kind to come on my show. And his name is Bob Klingman. And Bob, why don't you give your office phone number out in case somebody wants to get in touch with you?
Sure. My office number is area code 440-461-5067.
Okay. And if you happen to miss that, you can always email me, bill@bullingtoncapital.com, or just go to my website and say, can you give me that guy's name? And Bob's, you've been such a help to my practice over the years. It's really been a blessing. So glad to have met you. I always tell people I don't know anybody that is as excited about doing taxes as Bob is. And,
let me tell you that to that point. The thing is it's not doing them. And maybe you're in that boat too. But you come into problems all the time. I'm a problem solver, and that's what it's frustrating at times, but I do like looking for solutions.
Yeah. Well, that's great.
It may not be what you want to hear, but this is what it is.
Right. Yep. And I can promise you, you're going to do a much better job than 99.9% of the population. I've been around a long time and talked to a lot of people. And so you're easily approachable, very reasonable on your what you charge. I promise you that. And I call all the time and aggravate him with questions, but he never loses his temper.
Oh no, no.
Yeah. So, is there anything that you think sticks out for this year? I know we're going to talk a little bit about the required minimum distributions because those things have changed.
Right. For this year, like I said, I just mentioned to you before, the market was really up last year, and a lot of brokers, a lot of them took the gains that they had in the market. Now, a lot of people aren't realizing this. I mean, you have some big funds, and some of the capital gains, they approach $80,000 to $100,000. Well, you had that's income. People don't realize that.
Yeah.
And that's a big thing I'm seeing this year. I mean, and I'm seeing it quite a bit with people. I'm getting some real huge tax bills this year. But you got to explain to the people that, look, as I always say, okay, look, I always tell them, look, you give me that $80,000 or $100,000, and I'll pay the tax on it.
Right. I used to tell that to people all the time. It really made them kind of mad when I said that. I would volunteer to pay the taxes under the condition that they gave me the gain.
That's right.
But yeah, and that's true. I don't think you should let the tax tail wag the dog.
Right.
But you also don't want to have to pay unnecessarily.
No, you don't.
Yeah, and
don't.
We got
and that doesn't happen that often.
Right.
It really doesn't.
Right. Especially now, the ETF space has been the fastest growing segment of financial services industry for 7 or 8 years now, and again with the tax regulations to those that you don't have to actually claim any gains until you sell the stocks. Not all of them. Some of them actually still distribute capital gains, but the ones that I use, and the vast majority of them, will defer those gains until you actually sell it.
Correct.
So you don't get a negative surprise. Hey, you want to hang on, Bob? We got to take a real quick commercial break.
Will do.
All right, thanks. Listen to Bill Bullington and Bob Klingman right here on the Bullington Capital Report. We'll be back after these messages.
Count the broken roads I've been down, but all I know, something had to give. Something had to give. 'Cause living my life so wild and free finally caught up. Oh, it left me broken. Left me.
And we're back. You're listening to Bill Bullington right here on 1420 every week. Feel free to give me a call in my office. You can go to my website to reach out to me there. The website is bullingtoncapital.com. There's no cost for a first meeting to just see if you like me. That's basically about all it is. And we'll sit down and take a look at your situation, see what you think might improve it. And if not, then I'll tell you that too. But again, just go to bullingtoncapital.com. And I've got with me today Bob Klingman. He's an enrolled agent, does taxes, and I've been using Bob for years to refer clients to. And I just got, hey, Bob, are you still there?
Yes, I am.
By the way, did you see that email we got from my client down in Cincinnati?
Oh, Tom? Yes.
Yeah, he was elated.
I was surprised. Yes, he was.
Yeah, that was pretty good. So anyway, I forgot what we were talking about.
Well, the RMDs is what we were going to talk about there.
Yeah, okay. And I noticed this year, I mean, the changes were just crazy. And a lot of it was brought on because of the pandemic.
Correct.
But also, you know, I'm pretty sure it's because people's life expectancy, they're living a little longer than they thought they might.
And they did adjust the tables for that. They did. Slightly. Not a whole lot, but they did.
Right. Yeah, that's great. So if you have any of those types of questions, you can call myself or Bob. And let's give out your phone number one more time, Bob.
It's 440-461-5067.
Okay, great. And then again, if you weren't able to write that down, hopefully you're not trying to write that down while you're driving. You can always go to my website, bullingtoncapital.com, and we can reach it there. And I was just and this year, I think we probably had, I think we have about 40 clients that have to take RMDs.
Correct.
You know, at least 40.
Right.
And and they always want help with that. And in my E&O guy, the Errors and Omissions Insurance for Registered Investment Advisors, is always saying, look, Bill, you can't give out tax advice. That's why we've got you.
That's correct. Now, let's get a couple things clear with that the onus is always, the responsibility is the person's to make sure they do the RMD, and you are there to help them determine for what you have under your control what the RMD is. And that's why you ask them to call in. And, you know, between you and myself, we can figure out, and I'm sure you can, what they require to take out. Yeah,
what catches some people is that they forget to take all of their IRAs and do the calculation on each one of them.
Correct.
And so all the custodians, and we're not actually allowed to tell them, give them an opinion without all these disclaimers. You know, you have to check with your tax professional. You cannot take what I'm saying and just go with that. It's just, we're not allowed to do that. So, or you're not allowed to do. You could, and you could look it up online if you wanted to, if you got enough time to read all that and can understand it. But the bottom line is just, I feel so much better when they're calling you.
Okay, that's okay. Now, you know that at the end of, they're not due out this year until June 30th to the people. Usually it's May 31st. You will get a form 5498. Everybody gets those if you're in an IRA. It tells you the value of your account at the end of the last year. You have to have all of those to determine what your RMD, just like you said. So if you're in more than one investment company, you have to take all those into account, just not one.
Right. And by the way, those 5498 forms, they all look the same.
Yes, they do.
So just make sure you've got one for each IRA account that you have, and you should be good. And then I just kind of bundle mine together, and Actually, I don't have to do that because I'm not 72 yet, but just practicing. So that's a good point. I'm glad you brought that up. The Form 5498.
People don't know what they're for. I'm very surprised. Oh, I got this, and it says, and I said it's informative, but it's very important. It says you need to keep it, especially like you said, if you're approaching that 72 age at this point here.
Right. Yep. Absolutely. I forgot what date it is that you have to turn 72 by. I think it's December 31st. So the people that were born the last month in December, they really get kind of hit pretty hard for being born so late in the year.
Right. Well, it changed at the end of 2019. So if you were 70 and a half by the end of 2019, you were under the old 70 and a half. Okay. After that, after 2020, starting with January 1st, it was age 72. So if you use that figure, you would go back to what would that make it? Beginning of 1949 is the first 48. You would be 72 from there. So that's the key thing is 2020 is the year that they switched everything.
Okay, great.
Use your age and figure, okay, what age was I on January 1st, 2020? And that will determine if you're 70 and a half or 72.
Okay, great. So next year, what will it be next year? I'm just assuming that it's probably all 72.
They're all 72. However, the tables, like I said, the tables are all the same for 70 and a half or 72. The factors are all the same.
Right. Okay. Well, great. I'm going to have you give that number out one more time.
My phone number?
Yes.
Yes, it's 440-461-5067.
Okay. And again, if you couldn't write that down, you can just contact me, send me an email from my website, bullingtoncapital.com, and I will forward you the information, Bob, and hopefully we'll be able to help some people out.
That's very good. Always willing to help.
Oh, thanks. Thanks for calling. I appreciate everything you do.
Thanks, Bill. You have a good day.
Thanks. You too. Bye-bye. Yep. Good guy. So I'm going to spend the last few minutes talking about stocks because I know there are a lot of people that they only listen for that part of the show. And I will tell you from now on, don't tune in until 11:45 because that's when I'll start to talk about it. It is interesting. I mean, you know what? The market is incredibly strong given what's going on in the world. And here's the number one mistake most people make. They look at things that are going on in the world, and there are always bad things going on. This is really bad. But the market is actually going up. So instead of trying to predict what the market's going to do, you should look at the market's response to what's happening. There's a big difference there. It will improve your performance big time, I promise you. You when you're down, first of all, if you're down and you're upset, then you got your allocation wrong to begin with. You were too heavily invested in stocks. If you feel really, really nervous about it and you're upset and you're looking at your account, you should not been that heavily invested in stocks to begin with. Now that I've got about 5 minutes here, and I'm just going to bring this right to the stocks because I feel bad for those people. I'm going to go through and here, there's a company called Spartan Nash. It's a food company, SPTN. The stock peaked out a little over $40 back in 2017. Then it bottomed out looks like around $9 or $10 in 2019. Now it's back up to 34 and it's running. The reason I bring it up is it has a very low price to sales ratio. And next week I'm going to talk about this price to sales ratio and how you can use that. Once you learn how to use that, it is so much easier. I mean, it is so much easier to look at a stock. You'll be able to tell whether or not you're interested in a stock in about 30 seconds once you get that down. And now getting it down is probably going to be some effort, but once you put the effort in, you'll be pretty good. Remember I was talking about earlier in the show about value-oriented stocks? So here's Olympic Steel. Steel is one of the oldest industries there is. Well, again, I forgot where it goes back to. It goes back a long way. Anyway, this is Olympic Steel, and its symbol is Zeus. I always loved that symbol, Zeus. I thought that's pretty funny. But Olympic Steel, price to sales ratio 0.12. This has if any of you know who, Investors Business Daily and William O'Neill, it just closed above the handle on the cup and handle pattern that they talked about. He made really popular for a long time. Well, it just closed above there. It was 2.5 times its average daily volume. The stock closed right near the high of the day. Now, it doesn't get any better than that. Now, watch, if you're buying a stock like this, you're going to get stopped out more than half the time, by the way. If you're following the rules on the Look Out for the Bull website or the William O'Neill stuff, he used to say put a 7% initial stop loss on it. I wouldn't do that anymore. The market's too volatile for that. But I'd put at least a 10% initial stop on it. So if it drops 10% from your purchase price, you're going to be gone. If you're keeping your investments to 5% or so of that trading account, 10% of 5% is 1/2 of 1%. This is why I never panic. It's why I never panic. But ask an institutional investor if they were allowed to put 5% of their money in one stock. The vast majority of them are not. They're not allowed to do that. They hold hundreds of stocks. Why? Because they have to. It's the law. A lot of these companies, they would end up owning more than 10% of the share, and legally, they're not allowed to do that. So if you're a publicly traded fund, now that I hear the music, that means I got to say goodbye and ask you guys to tune in next week. This is Bill Bullington. I'm here every week from 11 to noon. Have a good week, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.